Good morning, everyone. My name is Christopher Vecchio, currency analyst with DailyFX. This is a live trading Q&A in DailyFX Plus. Just making sure audio and video are working okay before I square away these charts. If I could just have confirmation, we will get started right away. Han says it's good. If there are any adjustments necessary, let me know. I'm using a new headset here, so I'm just figuring out the best setup for this. Small talk aside now, this is a trading Q&A, so I want to go over a plethora of your questions, not focused just on what I think what's going on in the market, but really what you're looking for, so what I can do to aid your trading. Before we start, though, just a number of things. You might have heard in the background, that is my colleague David Song. He is part of the new Analyst on Demand service that we are running here at DailyFX, essentially a trading Q&A that goes all day long, presenting economic data, insight, interviews with analysts, and updates really all day long as a Squawk Box service to give you the best edge in your trading. So if you're interested in learning more about that, please shoot me an email, cvecchio@dailyfx.com. I'm going to put my information in the chat box here. Just point out that you are a live account holder so that I know to respond. You wouldn't believe how much spam we receive soliciting advice and strategy information, not from non-clients, but we would prefer if you were to just indicate that you are, so we could respond in an expedient fashion. If you would like to talk to me on a more pertinent and up-to-minute basis, I suggest that you get on Twitter. Okay, you could use StockTwit's Twitter. Really, the DailyFX real-time news feed runs through those services. You can find me there, cvecchiofx. Now, I'm stressing talking about and discussing what's going on in these market conditions right at the beginning because this is a big week in FX. And I say that because we have two potential big events on the horizon. Well, one of them has been realized. We had the U.S. government shut down officially today because of intransigence in Congress. What's new? We also have the potential for the Italian political stalemate to be resolved. All right, so we could see a significant euro-negative event removed off the table that would give a clear pathway for the euro to extend gains against, say, the U.S. dollar or even the Canadian dollar in the near term. And so, let's talk about these things. What's going on with the U.S. Congress? Well, essentially, we're at a place where an immovable object's met an unstoppable force. And why do I say this? House Republicans are attempting to leverage the United States credit rating and creditworthiness and the economy for policy changes that they lost in the 2012 elections, evidenced by the increase in the popular vote for Democrats, increase in the House seats for Democrats, increase in the Senate seats for Democrats, and the presidency. Nevertheless, they want the president to strike down his signature piece of legislative advancement, whether you agree with it or not. Just logically, it is unlikely that a president will repeal his signature achievement, what he views his signature achievement, and therefore it is highly unlikely that we're going to see any such resolution. We're seeing policy levered against economic growth. The Democrats will not cede ground, as they will not go against their own measures. It's a matter of legacy. It's a matter of ego. On the same side, Republicans don't want this to go through, so we are at a stalemate. Whether you agree with Republicans or Democrats, it doesn't matter because neither side is showing a willingness to find compromise. And that's all that matters because at the end of the day, the government is shut down. So that is leading to U.S. dollar weakness across the board. Now, this isn't just a risk-off move for one very special reason. The Federal Reserve remains in place with its QE3 program at $85 billion per month. That's $45 billion in U.S. Treasury purchases, $40 billion in mortgage-backed security purchases, and given one of the reasons for the Fed to hold on to its QE3 program in September, the potential for a U.S. government shutdown, there's little reason to believe that if the government shutdown continues, that the Fed will taper this October meeting. And therefore, as long as the Fed remains in its accommodative policy stance and the U.S. has not breached its debt ceiling yet, risk might as well be on. It's just a dollar negative story at this point. We're seeing that manifest in the Australian dollar, which I have up here. Yesterday morning, I was posting that we had seen resistance turned into support right near that 92.20 figure. We had put in a higher low, and we had started to breach this descending trend line. And if we had started to breach this descending trend line, we might see that rally up. Sure enough, the indicators cleared the way. The U.S. government issues have not been that risk-off catalyst, and indeed, with the RBA holding at 2.5% its main rate, we've seen the Aussie dollar jump about 100 pips on the day. I think the Aussie dollar is coming into near-term resistance, and this is answering one of the questions I see here about Aussie dollar. Do you think this rally is for real? I do think it's real on a technical basis and on a basis that the RBA did not cut. There was a small expectation, about 15%, for a 25 basis point cut going into the meeting. And with the Fed now essentially guaranteed not to taper in October, it is very likely that risk is on for the Aussie dollar. We might be seeing some near-term resistance, however, come up here, 94.55, 94.60. We do have the swing high on the 23rd at 94.56. All right, we have RSI having broken the downtrend on the 8-hour chart. Okay. That is coming up towards that overbought territory, and stochastics, which had broken higher, are reaching that overbought territory. So Aussie may be a candidate now that the breakout has occurred, maybe a candidate to look to buy on dips. Okay, I think the ideal situation for risk, generally speaking, would be for the U.S. government to stay shut down for at least several days, for there to be zero tension in negotiations over the debt ceiling. I say zero tensions because I think we're going to get to the point where both sides realize that neither wants to lose political face value ahead of the 2014 midterm elections, which will, of course, put a number of congressmen and women up to the vote. And in light of those regards, I don't think that that a debt ceiling showdown is very likely so long as the government is shut down for a period of time. We're going to see those complaints come in, the electorate speak up. That's usually when we get a deal done. And if that's going to be the case with the Fed staying on hold, as long as the debt ceiling isn't breached, and as long as there is a continuing resolution to push the debt limit higher, risk remains prime now that the government has shut down, as that will mean the Fed will stay easing for the foreseeable future, at least into December. All right, and then if we get to December, how much can change between October and December if there is a negative impact from the debt ceiling and this budget debate? Then it's likely Bernanke doesn't adjust his policy at his last meeting, and we wait for the next Fed chairman, likely Janet Yellen, as it seems she is the favorite at this point in time. So so how long is the U.S. government going to be closed for? That is something I don't know, and really no one knows. It really depends on where these negotiations go. You know, at the end of the day, I think in terms of just political face value, Republicans have more to lose than Democrats, and that's only because just be where popularity polls are, right? Even though a majority of Americans aren't for Obamacare, so to speak, they are more against the government shutting down. They do not think that defunding Obamacare, the Affordable Care Act, is the prescribed policy path to get this policy change to occur. Leveraging the economy is not going to be popular. Therefore, because we're seeing that more people are finding that defunding Obamacare is the unpopular measure, it's likely that Republicans are the ones that will lose more face value. Again, this is not an anointment or a suggestion of where my political allegiance lies, just purely based on poll numbers and what we've seen happen previously. Certainly, I would think that the impact of the 2011 debt debate had an impact going into the 2012 elections. And again, we did see Republicans lose seats in the House, the Senate, and eventually the presidency, losing the popular vote overall. So it's important to consider that if for 2014, if the main political impulse will be to hold on to power, or at least try to take back some more power in the Senate and the House, then having the government shut down and the economy hurt for these fiscal reasons, it's not going to be a long-term positive strategy for Republicans. So eventually, I think the government will open. Maybe it's a week, maybe it's a week and a half. That's going to lead to a lighter a negotiation for the debt ceiling, and therefore, in an effort to save political face, we should see things come back online in a week or two. Because, again, that will result in the Fed staying on hold because of the uncertainty of the impact. It's all about whether or not businesses think the impact could go on. Do they think that this intransigence in Congress's part, will it continue? Will the government shut down again in the future? It's all about if this confidence remains. And if this confidence does remain, then there's reason to believe that, the Fed's going to stay on hold and risk could continue its way higher. So what would be the worst case for the Fed meeting? What would really throw the markets into disarray? Says guest, feel free to put your name, and it'd be great to know who you are, because this is a very important question, and so I appreciate your attention to detail here. What would be the worst case scenario for the Fed? An immediate resolution to the government shutdown, a resolution to the debt ceiling, and then a taper. All right. Now, it's not worst case scenario with the Fed because, that really depends on your perspective. If you're a dollar bull and they start to taper in October after these political issues, that's probably going to be a good thing. But worst case scenario would be if the government, goes through these motions and the Fed does indeed taper, because that's not being priced in right now. We just took a look at U.S. Treasury yields. I think you can best expressed by, say, the dollar yen over the last several days. Okay. We see go before pre-Fed, dollar yen continues to fall. Dollar yen is exceptionally sensitive to interest rate differentials given the proximity, or at least the small margin between U.S. and Japanese rates. We see that the dollar has just been eroding, and that's not pro-taper. So that would all reverse. If the Fed were to taper, it would certainly be unexpected as markets are positioned for a continued period of Fed easing at $85 billion per month. Okay, so I like the yen for several reasons, actually. If the tension does not alleviate in the United States, in Europe, it may be ironic that the country with the world's highest debt burden is seen as the safe haven during these debt affairs in the United States and Europe. Nevertheless, it's all about liquidity, and the liquidity of the yen is highly appealing. Now, today we already saw news that, I'm going on a 5-minute chart here, we saw news that the government would proceed with its sales tax hike. All right, and quite frankly, dollar yen is falling because the market believes that the sales tax hike is going to be effective. So a shoring up of the fiscal situation in Japan is yen positive. Any measures that aren't going to derail the economic trajectory of the economy are going to be yen positive. With the upturn in Japanese economic growth, it's seen that any measures that might stunt consumption, taxes are consumption negative, and therefore falling consumption would lead to falling inflation. Because the economy is doing so well, there's no real concern that the sales tax hike is going to be a veritable drag on consumption. And in that case, then inflation shouldn't slow, and if inflation's not going to slow or pull back from its recent advance, then there's no scope for additional easing by the BOJ. Now, the BOJ has said it remains prepared to act. We have to respect that because they have shown that they are serious about acting. But the big picture is that unless economic growth in Japan turns lower, which it hasn't, we're going to need to wait and see how that evolves, obviously, because the tax hasn't hit yet. But if economic growth remains sturdy and consumers don't adjust their expectations for a smaller amount or reduced disposable income from the sales tax, then the yen should continue to strengthen. So with the yen, at least now, the knee-jerk response is for a stronger yen. We see U.S. political issues proliferating, and we see scope for, now an Italian political crisis. The yen remains appealing overall. In terms of the Italian political crisis, I think that's easing by a fair amount. I think Eurodollar the last few days really emphasizes how the political crisis has eased just overnight. We see here yesterday morning around 8 o'clock, news emerged that it was there was a chance that up to 20 Berlusconi supporters were going to defect and align with the current Prime Minister Enrico Letta so as to ensure continuity in the government. And that's really what's needed in Italy. Less political crisis, less fear-mongering, more policy making. And with the gridlock government, it's unlikely that we're going to see much policy making until this issue is resolved. A lot of this has to do with the vote the Italian Senate's about to go through on the 4th, I believe, whether or not to ban Mr. Berlusconi, the former prime minister, from politics. If so, that's why the government coalition will collapse. Nothing more, nothing less. It's all about power and ego. Always has been, always will be. So don't look further than that. If the government does collapse, okay, we have to see if those senators realign with Mr. Letta. If they do, that would be Euro positive. It doesn't matter if there's a continued threat of a breakdown in the coalition, so long as Mr. Letta has the votes. That confidence vote will take place tomorrow. So all hands on deck for the Euro. It's going to be pretty simple. If the government stays together, it's Euro positive, no new elections. If the government falls apart, it will be Euro negative until that issue is henceforth resolved. I am more hopeful about the European political issues being resolved than the U.S. ones at this point in time. It just seems that at this, where we're standing from the current juncture, the moderates in the obstructive policies on both ends of the spectrum are more likely to resolve their issues in Italy than in the U.S., right? So in that case, the euro should suffer less than the dollar against the yen if risk aversion does pick up. That's my personal view. That's how I'm trading it. I think that at this point in time, euro yen is less appealing than dollar yen to the downside. That was different to start the week, of course, as we saw that the euro was significantly weaker as that government shutdown fear really loomed. Two patterns I'm watching right now related to the euro dollar and to the euro yen. Okay, it's important to respect that the June and August highs have turned into support. Resistance turned support. We see that we have a triangle break here. And now we're seeing potential for a flag. Let's go down to the 4-hour chart. Okay, there's potential for a flag here. So over the next 2 days, if we see that these Italian political issues are resolved, there is definitely scope, technically, for a breakout higher, right? Just this is so clean, picture perfect, right? Resistance turn support. I couldn't draw it better myself. See how we're leveling right above that trend line? Now we're flagging. If we do indeed see a resolution of these Italian political issues, this could be primed for another rip higher. All right, where would we look into? We're at 135.45 here. The yearly high is coming in at 137.10. That to me would be the first big place to look. It'd be hard pressed to suggest that the euro dollar would extend much higher than that on a rally. And I say that because if we look back to 2011, when these U.S. political issues came into play, even though the euro dollar didn't have significant downside, it did fall roughly 500 pips over the course of those 2 weeks in late July and early August when the U.S. was downgraded and we reached ahead in those political issues in the United States. So just on the pure risk aversion play, we could see a rally, and then if the U.S. political issues evolve and get worse, that's where we could see a topping near the yearly highs and maybe a pullback if we get towards breaching the debt ceiling. That becomes a reality. So it could be a pop and then drop here in the euro dollar. But right now, technically, I'm looking higher. Fundamentally, I think the near-term picture is there as well. What will the ECB do, of course? And that's the big, that's the other big outlier here. I think the ECB is becoming a more negative threat to the euro than we've realized, okay? And that's hard to make a claim when the market hasn't acted on it because, that's pure conjecture, right? It's a counterfactual argument. Why even bother saying that? The thing that's really come to people's attention in the last few weeks, at least this week, has been slowing credit growth in Europe. And back in August, Mr. Draghi mentioned these slowing credit growth conditions, noting that European excess reserves at banks, liquidity at banks, had fallen back to those LTRO 1 levels, December 2011 levels. And we've actually seen inflation data start to come in weaker. We're at a post-crisis low now in Eurozone inflation, all right, lowest since February 2011. So capital at banks is low, inflation's falling, credit growth is low, PMIs have now started to to pull back briefly. And all this points to a near-term pullback in Eurozone economic growth. Not necessarily a recession, just a slowing of where we are. So why is that important? Because the way the European Central Bank addressed these same concerns just over a year ago, almost 2 years ago now, was through those LTRO 1 and 2 operations, totaling over 1 trillion in euro injections into these banks. The euro fell sharply on these injections, right? We go back to December 2011. Okay. November and December 2011 as those LTRO fears materialized. And I say fears because it was a euro negative event. Pricing in, and then the actual announcement. And then again, starting in February 2012. Immediate downside. And eventually, as those problems proliferated and those funds continued to be injected, we saw the euro fall. Okay, so supply of euro rises, simple supply and demand basis. Supply rises, price has to adjust lower. Same thing here, all right? It's important to consider that trading is just like economics. Sellers come in when supply exceeds demand. When buyers evaporate, that's when selling takes place. Simple as supply and demand in economics. All right, same thing here. I would be looking higher in the euro first, and then lower, maybe some resolution in Italy, and then we see U.S. fears mount. If there's no resolution in Italy, this would be a false breakout here, and I'd be looking lower. I'd be looking underneath recent lows 134.60 before I consider going short, right? Until we break 134.60 or we get a daily close above 135.70, we're still in a range. And there's no reason to get ahead of the curve. For example, yesterday, I can tell you that I tried scalping Eurodollar to the downside. All right. I had waited for a bounce back to these former lows. I had gotten some shorts in right when I got to work around 135.05, but we didn't get the break of 134.60. So I was geared up too early, and then I was soon stopped out on this rip higher in the news. It's one of those things where if I had waited patiently, I wouldn't have put capital risk that I ended up losing for trying to front run the event risk. I should have waited for the resolution. Same thing here. If we see the resolution occur, we know that we're primed for a break higher, but I'm going to wait for confirmation. If we have failure, we know the technical level that's being respected to the downside before sellers truly can say they've taken control, before we can say that the range is broken. And so for me at this point in time, I'm looking bullish on the euro, but I'm open to both situations, and having flexibility in your view is very important. All right, it's the number one thing that a trader can evolve with. Staying stubborn over what you think the charts are saying is a great way to lose money. You should bend your point of view to the charts, not bend the charts to your point of view. KJ, seeing that this is the first time coming into this trading Q&A, appreciate you for coming out. We're going over a lot of heavy topics here. So I suggest at some point in time you eventually move over to the content we offer in Daily FX Education. So you were looking at Aussie dollar, and you want to just go some basic Aussie dollar technical analysis, right? And I think what we've seen recently is a great example of how techs work. And I'm going to go out to the 8-hour chart because I've been using the 8-hour for cues on Aussie dollar the last few days. And why do I say 8-hour? I look for the time frame that best captures what's going on in the market. We see this 8-hour candle here. I'm going to highlight it in just this one blue circle. Let me make this blue. Okay, so we have this candle to start the week. Let's go down to a 1 hour. All right. So what do you see here on the 1 hour chart? This is a doji candle, spinning candle, whatever you want to call it. To me, we see that we set a new low, we set a new high relative to the prior periods. It looks like it could be a turn. All right, it could be a sign that the market's at a point of indecision. It's also coming at a point when we look to former price action. we see that at 92.80, we had a former high, and then we had a former low form above that level. So we have support, evidence that resistance, okay, make this a little clearer. We have evidence that resistance turned support is in the region. We have a candle that suggests that indecision has been reached at this level, so it might be a good time to look for long. So we go to the 2-hour chart and watch this evolve. Same thing. Now we have a bullish encompassing candle, right? Make this smaller. Right, you see here, now we have another indecision candle. This time it's encompassing the prior one on the 2-hour. We go to the 4-hour chart. Now we see that it's a fully formed hammer at support. Okay? Go to the 8-hour. 8-hour shows indeed that this level held on the larger time frame. So this was an area to look for at support, a sign that the candles were showing you that market psychology was changing. Now, evidence in the indicators. I went to the 8-hour indicators, and you could see this on StockTwits. I posted this in the Daily FX Real-Time Newsfeed. That the indicators started to break higher. We see that the downtrend had broken in both RSI and stochastics. You're not looking for the indicators, in my opinion, to look to buy or sell. You're looking for them to change the nature of their behavior in respect to the current trend, right? So within this downtrend in price, we had seen that RSI had held this downtrend. And we see that on that 8-hour candle, that RSI had broken this downtrend. So there's reason to believe that the nature of this decline was changing. We also have confirmation that stochastics are breaking higher. And so now we see that the decline of stochastic, which had governed price throughout the downtrend from the 19th, had changed as well. This is evidence of the evolution of the psychology of the chart. All right? And sure enough, what happened overnight? The RBA did not cut its key rate, and the Aussie is ripping higher now. So you're just basically using support and resistance, straight lines on the chart, horizontal lines on the chart, to identify levels at which the market has reacted previously. And you look for the candles to tell you the story. Right? This is a good example of a reversal. We see significant selling, but the selling is immediately negated over the next period of the next hour with buying. A strong sign for a reversal. No continuation lower. So you can use the charts as a map for what's going on in the market. And did we know that the RBA was not going to cut rates? No. I mean, there was evidence to suggest that they weren't. But certainly the charts were showing us that the market was beginning to position itself for such an event. It was respecting the fact that indeed that might have been the outcome, and traders had come to the market in a more bullish perspective. So you can use the technicals to actually front run this economic data. If you had gotten in and you saw this chart evolving overnight at the start of the week, you'd have been able to capture the breakout. And now we're coming up to first resistance in the breakout, right? 94.55. Might be an interesting area to sell at. We see resistance once, twice. And so with the indicators now reaching those overbought levels, okay, and we actually see that the slow has turned, but it looks a little premature. We see that when we get up to these levels, we have near-term tops. So it's possible that we could be coming at a near-term point to look for relief and then look to buy a new dip. I mean, if we're going to sell off at 94.55, this is purely hypothetical, we're going to want to see 94 hold, right? And why is that? Well, we see that it was resistance, and we see that we have a reversal candle, a reversal pattern here, right? We try to turn lower, we set a new low, but we close above the former high. There's evidence that 94 to 94.10 should be the new support region. So if we get selling into 94, 94.10, it might be good for a look for the long side now that we know that the broader downtrend has started to break. You know, KJ, I would suggest reaching out to my colleague James Stanley. Just tremendous, tremendous with on the education side. One of my favorite guys. I love picking his brain whenever I have questions about what's going on in the market. You know, you're always still learning as a trader. To think that you've learned everything as a trader is a dangerous folly. And so, you know, I've been trading for about 7 years now, and I can always learn something new. It's having your hands on educational material and staying up to date is very important. And you know, it's education should never be dismissed as novice or amateur. Those that are dismissing it, I think, are really missing out. So you know, reach out to James Stanley. He can definitely help you get you on track with your education if you're new to Forex trading. So we have a question about scalping here. Pound yen. Pound yen is a really I love trading pound yen, especially what's going on with the pound and the yen specifically this year. I mean, it's been an incredible ride, right? Talking about 4,000 pips the last 2 years. Really incredible. But in terms of the bigger picture, absolutely nothing, right? Yeah, 250. 2007. We're still at 158. So just keep in mind that if you know pound yen, the recovery in pound yen, there's a long way to go before we consider the broader move lower over. But nevertheless, pound yen, we're seeing questions here. You know, really interesting chart today. Okay, because it looked like we were getting ready to break out higher, and we have a major inverted hammer at 160. You actually put in a lower high with respect to 160, right? The high in September was 160.02. Today was 159.99. We have a hammer here. You know, looking at the 5-minute chart, because this is a scalping question. You know, this is a great example of that support turn resistance we're talking about, right? We see, generally speaking, that this 159 level was holding up. 150, 158. 95. Let's point a little. Here we go. We'll call it 10 pips, 158.90. Okay. So we see that support, 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 and once we broke through, resistance. Okay. Okay. And then we start to flag here, an astute observation. I'm sorry I couldn't get to this question earlier because this indeed was a good, who is this? Keith, great observation here. And would have been a nice trade. I hope you took it. I certainly did not. I am short dollar yen for what it's worth. So I am exposed to some of this yen strength now, but I'm not playing pound yen. I'm certainly not playing euro yen right now. But euro yen could be interesting up here as well. But pound yen, you know, breaking this consolidation, Keith aptly points out that we had a flagging pattern here, and we might be seeing once again support turn resistance, right? Pair is struggling now to get back above 158.75 in these rebounds. We're holding the low so far, but it does look like pressure is starting to build to the downside here. Pound yen might be looking to trade lower over the coming hours. And now we've seen a near-term, what could be a near-term top in play, right? And at this point in time, you know, if this is going to be the break, then stop should be contained to 160, okay? Because if we see a reversal here, then we know that this is not a top and that this is just a shakeout. But if we are going to break lower, going to the daily chart here, you know, there is potential. Actually, let's go to the 4-hour first, okay? We do see we have a concerted range here. This would really gather pace. Okay. We see that the median line really extends down to 157.50. We could tinker with this to make it match up as such. I mean, that still looks good to me as well, but it's pretty clear that off the 905 high on the 4-hour chart to the lows we saw on the 24th of September, this is the key support here. And if we see a break, we could see pace gather below 156, and then we'd have real potential for a near-term top, at least against the lows we saw in August. Maybe be looking lower into looking into 155, right? That being the near-term support here. So a break of 157, 157.70, 157.70 here. That's going to be key, and then below 157, it could be just a nice tumble into 155. So I'll be watching for that, but pound yen, already action on the short-term charts. Going back to that minute chart that Keith was pointing out, that we see that we were flagging as resistance, support had become resistance, and now we're showing signs of breaking lower. Indeed, this is something to watch. If we break the daily lows, this could be something that gathers pace. Now that the government's shut down and we have at least the near-term turn in UK data, we saw PMI coming a bit softer, so the fundamental tone is not for a beat there anymore. Maybe we've reached a near-term top as Eurozone economic data pulls back, but there's reason to believe that the technicals are pointing to a turn lower in pound yen right now. Kiwi dollar here, right? Just a moment. And just pointing out that pound yen is going, so I'm thinking about taking a small short here. All right. So putting a small short on here. And just because we've seen that this zone has become, I'm just going to illustrate this in real time here, just so we see that this zone has become the support turn resistance. All right. That means I'm going to want to put my stop right above here. So I'm going to put my stop at 159 for now. All right. Okay. So now that we have that there, we're going to see how this works out. If we don't get the break, I'm going to take a small 30 pip loss. I'm willing to play with that because we've already seen that the market has shown signs of turning. In fact, if we get up into this zone, I'm willing to add a little bit to my pound yen short. All depends on current market conditions. But right now, it looks like pound yen might be trying to break lower. So we're going to watch for that. Even the swing lows we had going back on the 5-minute chart here. Okay, we already see that the lows on the 30th that broke higher yesterday, that was interim support, we're holding below there. You can see it on the gray line here, right? And that's where we've indeed started to flag. So I think there are signs that pound yen might be trying to turn lower. It's going to be a key few minutes here. We'll keep an eye on this, but I am short here looking for a break. Seen a lot of questions about Kiwi dollar. I apologize for ignoring. We are coming up to the 7 o'clock hour, so this session is going to be over in about 10 minutes. Let's go to the daily chart here. I am long Kiwi dollar 81.65. All right. What led me to that? Well, let's go to that 81.65 level. Okay. Again, support, turn resistance, break, vice versa. Support, turns resistance, and then a beautiful gap higher, and then holding it as support here. Okay. This could be a double bottom. The double bottom measured move. This is 480 pips. That means we're looking for 86.40. Okay? Now, again, showing signs of support and resistance. Law of polarity. Failure there. We also have now, let's get this an hourly chart up here. From the high, Jamie Setley points out, our chief technical strategist, that this is a 5-wave advance from the high, 5-wave decline from the high, excuse me. What does that mean? It means that we are seeing an impulsive action lower, which means that this could be a bear flag, all right? If that's the case, and we see that the lows on the 25th are undercut under 82, right? We could be seeing a deeper pullback. If the flag breaks and you're going to be aggressive here, below 82.60, I mean, I would prefer really, I wait for confirmation below the swing lows. So, below 82.45, we might have this could be a veritable bear flag. I would be putting my stops above 83.50. Again, I will be looking to trade this myself. I would be looking to close out my long from 81.65, all right, if we get below 82.45. I didn't take all the profit I could have above 84. I was looking for 86.50, but if this is indeed a bear flag forming here, I'm going to want to get out. I'm not going to be upset that I didn't take all the profit I could. I'm going to be pleased with myself that I took profit at all, and the fact that I reduced my risk in the process. So, respecting the technicals here. We're still seeing that we're holding in this channel, so I'm hopeful that this turns higher, but below 82.45, I'm going to be out of my bull position and be looking short, as it could be meaning that that a bear flag has indeed formed. All right, and then again, that means that channel support had broken. So Kiwi dollar, that's what I'm looking at. I like this big picture for a move up into 86.40, given the nature of the double bottom. But if we do see a break here, I would be very open to seeing a pullback, towards 82, towards 81.65 again, and looking to reload long, depending upon what's going on in the broader market and what other issues are at stake. So, mixed across the board right now. Just not a fan of the U.S. dollar, right? Dollar does not look good here. Unapologetic about how bad the dollar looks here fiscally and now monetarily. As long as the government shutdown goes on, the higher the likelihood that the Fed remains with QE3 in place. All right. Let's go to gold. Now, gold, this is really interesting to me for gold, that gold hasn't gained ground on these U.S. issues, right, or these Italian issues. And I think that speaks to the nature of the market in terms of interest rates, right? Higher interest rates, as long as real yields are positive, okay, then gold loses its value, or at least its appeal as a hedge against fiat erosion, for lack of a better term, right? A fiat dilution. So if your currency maintains value and continues to, you retain purchasing power, then you don't have to worry about storing your money, your wealth, in a fixed commodity like gold. So with yields higher, gold's value, its appeal is definitely diminished. Gold, though, to me, is still seen as a check on sovereign credit risk, right? It is a good hedge against sovereign credit risk because it's not something that central banks can print. Therefore, if gold is truly to gain traction, we're going to have to see these U.S. debt concerns, these Italian political concerns, really, really, really gain traction. And, you got to look to August 5th is when the U.S. lost its AAA rating. August 8th is when the market opened and gold went from 1666 to 1718, peaked near 1921 within the next month. And that's really the peak of the Eurozone crisis as well. So if gold's going to gain traction, it really needs these political issues to pick up steam. For now, support is holding, right? But it's clearly teetering on the edge. Okay, so we're at a near-term junction here in gold. If we do manage to climb here in gold, I'm not going to be shy about it. I'm going to tell you that there is an inverted head and shoulders that's formed. Okay? Neckline. We have to see a break above 1435, but head 1180, neckline 1435. Okay, roughly 250 points there. Looking back to 1680, sure enough, we have former highs in that area. So gold really could be in for a nice breakout. Again, 1180, 1430, neck minus the head. Add that to the neck. Add that to the neckline. There's our profit target. So gold, interesting point here. I'd be very careful the next few days, watching these lows. We could draw it to the absolute low points, but we see that the market really has been. We were watching gold on a closing basis, right? That looks like that's the true indication of what's going on. So if we see a break higher above 1350, gather pace above 1375, and then really would be looking for the break above 1435. And if 1435 is there, then I think we should be looking for a move into 1680 in gold. And that would go with a deeper problem with U.S. political issues. Fed staying on in longer, U.S. government shutting down for a long period of time, and a breach of the debt ceiling increasingly likely. So, gold, could break higher, but we're at the crossroads here. So, it's worth keeping an eye on the next few days. What pairs best today on the U.S. shutdown? I think you got to be playing dollar yen, because if the shutdown, the fears gather pace, risk aversion is going to be sucked out of the risk appetite is going to be sucked out of the market. And if we see that risk appetite's turning, Aussie yen is going to be the place to look at it. Oh, actually, I haven't seen this chart since that double bottom call. All right, that was nice. For now in Aussie yen, I think the rebound higher today might be deceiving, right? We're seeing that even after the RBA, the market is still pretty averse to getting too excited over what's going on. It's good news that we have broken out, and we are seeing that indeed the trend line has broken, but I like using horizontal lines more than vertical, more than diagonal lines, right? And so for now, we're seeing that 92.40, which has been support, right? Serving as resistance. Bit of a divergence in RSI as well, right? Price makes new high relative to the last peak in RSI, but RSI makes a new peak relative to price, but price isn't there. You usually want to see price lead. RSI leading is not necessarily a good thing. Similar thing here as well, right? Different type of divergence. New high in price. Momentum could have broken higher, but we lost the uptrend. It's almost picture perfect, right? So let me just remove a bunch of these. Right, so we see that the nature is changing. This would be an interesting place to look short. If we have, confirmation hourly, I'd be looking at the lows. All right, but there's certainly evidence of risk aversion in Aussie yen. That could be possible here, right? We're going to see how this evolves. We're going to watch how price interacts here, but Aussie yen stands to suffer the most if these U.S. issues really come to a head. I'm just going to go back to 2011. Right, this is July 2011, 85 down to 76 over the course of 2 weeks. The Eurozone issues 82 down to 71 over the course of 4 weeks. Aussie yen is really sensitive as a carry trade instrument, and I would expect that it would suffer immensely if these U.S. political issues don't resolve themselves. Here, great example, 82, 92.38, 92.38.3, so technically a new high. Let's see on the bid ask. Yeah, it's a slight differential there. So on the ask, it's not quite a new high. Nevertheless, we do see this spinning top here, carving out a range for a potential flag. So Aussie yen, Aussie yen is interesting here as well. It's all about the yen pairs to me. Okay, at this point in time, it's all about the yen pairs. That's where I'd be looking right now, especially with the yen gaining steam on what Abe said. So that's actually all the time I have for today. We went over a ton of pairs. A lot of focus on this political risk in Europe, as we should be focusing, especially in the United States as well. And we should keep an eye on the headlines. The technicals are a good roadmap, but we can't ignore the fundamentals, which to me are the storms. If there's a blizzard and you're driving up Route 95, from New York City to Boston, you're probably going to have to get off the road. It doesn't matter that the directions your GPS still says to go north. It's that type of situation where you have to be flexible, and if the charts start to turn, it doesn't matter what they said a day or two ago. We have to be flexible to the effective headlines and fear on market on price action, right? So that's all I have time for today. Let me just check if my colleague Walker England is up next. I believe so. No, unfortunately, there is no webinar today at 7 a.m. Instead, it's at 9:30 Eastern, right at the U.S. Cash Equity Open here in New York. That's 13:30. 11:30. Oh, 13:30 GMT. Mine just got scrambled there. 13:30 GMT. James Stanley will be on for finger trap trading, his scalping session. Great use with moving averages if you're interested in trading momentum. He is, again, a phenomenal trader, in my opinion. That is not FXM's opinion, but I certainly think it should be. But it's my opinion. He has helped me a great deal in my trading, and I think he has a lot to offer. So head out to his finger trap trading session. That's in about 2.5 hours. All right. Feel free to ask me any questions via email, StockTwits, Twitter, DailyFX Real-Time Newsfeed. Gave you my contact information earlier. Just indicate that you are a live account holder with FXCM if you do send me an email. Twitter I respond to, indiscriminately, but with emails I like to concentrate my efforts towards those clients, not just necessarily someone looking for free advice. So feel free to indicate that as well, and I'll get back to you as soon as humanly possible. Aside from that, today, event risk coming up, we do have US ISM manufacturing due up at 10 Eastern. Christian Kerr will be covering that live at 9:45 Eastern in Daily FX Live, the front end. So be sure to tune into that if you want to step away from James Stanley's scalping webinar, Finger Trap Trading, here in Daily FX Plus. That's all the time I have for today. I appreciate everyone coming out. You have my contact information. I will be back on Thursday for the ECB meeting. And I'm sure the euro will be looking a lot different over the next 2 days, given what's going on in Italy, given the magnetic pull of this ECB meeting. So keep an eye on those charts, keep an eye on those headlines. Be sure to stick around dailyfx.com for all breaking news. I'll see you guys soon.